So probably the biggest question that I keep getting asked right now is, are we in a stock market bubble? And if so, when will it pop? Well, this is clearly coming off of the fact that the economy is in horrible shape right now. And even though we did have a pretty nasty crash there in the stock market around March, we bounced off of those lows at a pretty fast rate. And that's leading to a lot of people wondering if a bigger crash is on its way. Well, in today's video, we're going to cover three very clear signals that are pointing to the stock market being in a bubble right now that may cause a significant crash sometime, let's call it within this year. But then I'll transition over to a counter argument and give a few reasons why we may not, in fact, actually see a big crash, followed by my overall conclusion and my personal opinion on all of it, as well as some predictions on what I think will happen and what I'm doing myself to get through all of this and prepare for anything that lies ahead. But I really hope you guys enjoy this update on the stock market and everything that's going on. And if you do, please consider hitting the like button. It really helps the channel survive and grow, and it means a lot to me. But with all that said, we got a lot to cover, so let's go ahead and dive into the three very clear signs that are kind of pointing to a big crash happening soon. And the first of those has to be the current state of the economy. And nothing really tells us more about how badly the economy is being destroyed right now than unemployment rates and GDP. Well, starting with unemployment, dating all the way back to the 50s, the highest unemployment that we've ever seen was around 10%, which only happened twice, the last of which was during the Great Recession of 2008. Now, since then, we've worked incredibly hard to bring that number down over the past decade or so, and that's ultimately meant more jobs, more money in people's pockets, and a booming consumer economy that lifted the stock market to record highs. That is until this year, where the global health issue resulted in most economies around the world completely shutting down, with businesses forced to temporarily close and workers forced to stay home and subsequently file for unemployment. And as a result, our unemployment claims here in the United States shot up to a record high that we have never seen before in history, including the Great Depression of the 1930s. In fact, just the past month and a half, we've lost over 30 million jobs, which is easily more than the 23 million jobs that we gained ever since the Great Recession of '08. So it basically took us just a couple of months to erase more than a decade of progress. That's pretty crazy. Now, you could argue that unemployment benefits help, but I highly doubt that most of those people out of work are going to be spending their unemployment checks on anything other than bills and groceries. And, of course, there's always going to be those knuckleheads, but other than those, I really don't think people are spending money on, again, anything other than like bills and groceries, since many don't even know if their jobs will still be around once all of this is over. Speaking of which, the government has now spent nearly $700 billion just on payment protection loans, which is basically money that is given to businesses so that they can afford to keep paying their employees. But even with all of that stimulus, analysts are still projecting a horrendous second quarter. Back in April, JP Morgan was forecasting a 40% drop in GDP and an unbelievable unemployment rate of around 20%. And I don't know if they've ever updated those figures. I haven't been able to find any updates on that, but to give you some context, those are some very similar numbers to what we saw during the Great Depression of the 1930s. And while many are betting on the final numbers to be a lot better than that, the fact of the matter is that we are already in May, and yet most states in the country are still under some sort of lockdown. So to think that Q2 will be anything short of a depression-like disaster, I think is really being a little too overly optimistic, in my opinion, considering that both April and May are included in the second quarter, and many don't even see us opening up in a more meaningful way until possibly June. And of course, others feel that nothing will even return to normal until a V-shot is released. And while I'm more optimistic than most on us having one by the end of the year, which would be incredibly fast, that would still mean that 2020 as a whole will experience horrendous numbers in both GDP and unemployment, with the real recovery not taking place until the start of next year. And putting all personal opinions and theories and everything else on V-shots aside for a second, I really think that we need one in order for the economy to really jumpstart again, because I just don't see demand returning to a lot of these businesses like gyms and restaurants and the travel industry until people feel safe enough to be close to each other. And I just think the reality of the situation is that it'll probably take a V-shot to get people feeling kind of safe and comfortable again. But when you look at some of these restrictions that they're putting in place right now, like saying that businesses can open up again, but with less than like 50% of their capacity, these businesses are just not built to be running on like half of their capacity. And I think that's ultimately going to mean for the rest of the year until we really start to see a recovery is businesses having to lower their costs, and that's going to result in a lot of layoffs, which has obviously already started, and that's going to mean less money in people's pockets and less spending from the consumer, which is what this economy is built on. Again, I think next year is a different story. I think we start to see a recovery, and I'm very optimistic about that. I think I'm much more optimistic than the average person out there, but I still think that the reality of the situation is that the economy right now is being heavily destroyed, and to kind of deny that is just being delusional in my opinion. And that really brings me to signals number 2 and number 3, which is that number 2, I think the stock market is trading way too high when we look at valuations, so we'll take a look at those. And then number 3 is how it's being propped up by the government and the Fed. So we'll talk about that as well and what it means kind of going forward. And then I'll transition over to a counter argument and then share my personal opinion on all of it. Okay, now starting with valuations, well, just looking at the stock market, we can clearly see that it was not only a fairly deep crash of almost 40% from the highs down to the lows, but it was also the fastest crash in stock market history, with the second, third, and fourth fastest crashes all happening during the Great Depression of over 30%. However, that's not the problem. That crash was more than justified given everything that's happening. If you just decided to flip a switch and shut practically the entire world economy down, you better damn well expect the stock market to crash faster than ever before, and that's exactly what happened. The real problem, in my opinion, is that almost as fast as we crashed, we actually shot back up from the bottom by nearly 30%, leaving us down only close to 20% from our highs as of today. So given everything that is wrong with the economy, with depression-like numbers being reported all the time, to only be down about 20% right now, it just doesn't make a whole lot of sense. Even if we look at trailing PE ratios, which is a pretty fair way of looking at valuation, since we use earnings from the past year when the economy was still strong, given today's higher prices, we're still trading at some very high levels. The S&P 500 PE is still over 20, and it could easily be argued that given everything that's going on, that number should be a lot lower. For me, I think somewhere around 15 or so makes a lot more sense, but it would take the market crashing by another 25% from here just to get to those lower levels. I do think that's justified, but part of the problem is that expectations are still too high in my opinion. While FactSet is expecting a drop of as much as 20% in the second quarter in earnings and another 9% in the third quarter, they only expect a full year drop of less than 9%. Again, when looking at earnings of the S&P 500. So with the market still down by around 20% at today's levels, Wall Street just doesn't think it needs to crash a lot more because those earnings are not really crashing enough. And in my opinion, that in itself is a little bit of a bubble because I think those earnings expectations are too high. When you look at the state of the economy with analysts projecting such horrible GDP and unemployment numbers, to only expect earnings to drop by less than 9% for the year just seems too optimistic to me, and that in itself could set up for some disappointment if things get worse, and that could cause the market to drop down. In other words, the stock market is pricing in a V-shaped recovery without much consideration for how bad things really are and what some of the lingering effects might be. Take, for example, this article from The Atlantic that points out how whenever we go through horrible economic time periods like this, we typically see companies use the opportunity to replace former workers with cheaper labor, since nobody really blames the companies or holds them accountable when you're trying to cut costs because of how bad the economy is. And so then workers are just kind of happy to get any job that they can get their hands on, but that ultimately means lower wages and displaced workers. It also typically results in market consolidation, which reduces the number of employers that workers can choose from, and to lower costs, there will likely be more automation as well, even further displacing workers. And that's not even accounting for all of the mom and pop shops, as well as the gyms and the restaurants and theaters and retail stores and all of those other ones that are at higher risk of going out of business, or at the very least, obviously taking on a lot of debt just to kind of get through this, that will weigh them down for many years, if not possibly forever. Speaking of which, corporate debt will continue to break new records coming out of this, and that's on top of all of the debt that they've already been accumulating throughout the past decade. In part, thanks to those lower interest rates that have made it so easy to borrow, and now, of course, we're at zero interest rates again. In fact, around half of all our historical corporate debt has been accumulated over just the past decade alone, and that'll continue to balloon even more throughout this year. But it's not just record corporate debt that we have to worry about. One of the reasons why the market is up by so much to begin with is because of all the government and Fed intervention that involves printing or creating unbelievable amounts of money. We're talking trillions of dollars, lowering interest rates, providing huge loans, and buying very large amounts of bonds and corporate debt to stabilize the markets and basically prop them up. These actions, though, have led to US government debt soaring to unprecedented levels, topping nearly $25 trillion, with about half of that coming in just the past decade alone. Meanwhile, the Fed continues to create money and buy up assets to ensure companies don't go out of business, but that's resulted in their balance sheet ballooning from less than $1 trillion in '08 to more than 6.6 trillion today. That's close to a 600% increase. And if you think that's bad, over $2 trillion of that came just in 2020 alone. And you know how the stock market bottomed out in March? Well, that completely correlates with the exact time that the Fed started to buy all of that debt. Of course, we know that the Fed can't keep creating money like this forever and rescuing every company out there, especially the ones that had horrible balance sheets to begin with, because of what it can do to hyperinflation, as well as propping up bad companies that, a lot of people would argue kind of deserve to fail for not having stronger balance sheets. But as a result, the Fed has been dramatically lowering their purchases. In fact, since the high of over $500 billion for the last week of March, the Fed recently purchased only less than $100 billion, which is a cut of over 85% from those highs. In other words, the Fed is trying to ease out of its actions of propping up the economy and the markets. And without the Fed to kind of prop it up, one could argue that Wall Street will no longer be interested in buying stocks at these ridiculous prices, given how disgustingly bad the economy is. But will any of these things actually cause a pop, a quote unquote pop, to the stock market and send us to some lower lows, even lower than what we saw back in March? Well, a lot of people would say no, and I'll give you the few reasons why, followed by my personal thoughts and my predictions. Well, for starters, the Fed is not going anywhere. And just because it's slowing down, it doesn't mean that it's not there or that it won't ramp right back up when it needs to, as this article from Bloomberg clearly outlines with a number of statements and pledges that the Fed has been making recently. Those including pledges to continue buying bonds in order to keep the market stable, which we all know how much influence bonds have over everything else, as well as direct statements about how satisfied they are with the steps that they've taken so far, and yet they will continue to do more in order to support the economy and ensure a quote robust recovery, which is exactly why people think that we will have a sharp rebound next year, because eventually this global health issue will go away as we advance therapeutics and V-shots. And in the meantime, the government and the Fed are doing everything they can to make sure companies don't go out of business and employees have jobs to return to once this issue has passed and we go from the media kind of reporting nothing but horrible news every day to actually reporting good news as we gradually improve. On top of that, you could argue that there is in fact some pent-up demand for life to return to normal. And keep in mind, even though the market has been climbing recently, a lot of that has actually been carried by some of the largest companies that are not only performing very well right now, some even performing better in some cases, but also have amazing balance sheets and account for a large chunk of the stock market, those being companies like Amazon, Microsoft, Google, Facebook, and so on. But when you look at other parts of the market, like for example, the travel industry, many of those stocks have been heavily destroyed and are still down huge. In fact, the airline ETF Jets is still down almost 60% this year alone. But when looking at pent-up demand, back in early March, there was nothing but like negative polls and surveys coming out left and right showing that nobody wants to travel right now, which is totally understandable. Yet fast forward to today, after close to 2 months of lockdown, we have new surveys coming out suggesting people are eager to start traveling again as soon as all of this is over. This one from Preferred Hotels and Resorts surveyed around 4,000 rewards members, and over half of them said that they plan to travel this year once the restrictions are lifted, while 17% said that they've already started booking their trips. On top of that, over 80% of them are actually planning to travel by airplanes, which is kind of surprising. I'm not saying that airline stocks are a good investment, definitely not saying that, but I am just kind of saying here that there's an eagerness out there for people's lives to return to normal, and that will ultimately mean more spending in our consumer dominated economy. And I think that's ultimately what the market is looking at. What's going to happen once we get back to normal? This is something that perma bears just kind of refuse to acknowledge, which is that the stock market is usually forward looking. When you look back at the Great Recession, which was one of the scariest time periods to live through in terms of people going bankrupt, losing their jobs, losing their houses, and so on, most stocks actually bottomed out in October of '08, with the S&P 500 hitting its lows in March of '09. And yet we know that not only did the economy not start expanding until months later, but our unemployment rates didn't even peak until October of that year, which was many months after the market had already bottomed out. And even then, you still had nothing but pessimism all over the media, and everyone screaming about a double dip recession for even several years after, yet the market had fully bottomed out well before that. And given that this is an event driven crash, which they typically see much shorter bear markets and historically recover much faster, it does lend a little more credence to the idea that the market has already bottomed out, which was back in March. So just to sum it all up, what we've basically got here is a government and a Fed that is doing everything they can to keep companies from going out of business. We've got a bear market that is event driven, which we know typically don't last as long as others. And there's like 100 different companies right now competing to release a V shot to take care of this global health issue, and we could possibly have one as early as this year. We have a lot of eagerness amongst the population to get life back to normal, so possibly some pent-up demand there as well. And all of that is leading to the stock market being forward-looking into what things might look like next year when we start to see a recovery in the economy. So to bet against the Fed and assume that the market is going to pop and crash from here like 30, 40, or 50% or even more, when you look at the really perma bear kind of predictions out there, that's not a very safe bet in my opinion. What I think is much more likely to happen is a lot of continued volatility. Don't forget, we're in an election year right now, which are typically very volatile. And of course, we still have one of the worst economic crashes ever, and yet the stock market is actually trading pretty high when you look at valuations. So what I think is more likely here is that we see a correction of maybe around 10 to 15%, because don't forget, we're still currently down around 20% from our highs. So you add on like a 15% drop on top of that, and you're talking about a few thousand points off of the Dow Jones. I think that's much more likely, and I think that's very, very possible. We could definitely still see a crash happen, but I think what's much more likely is a smaller kind of correction because of all of the action being taken by the Fed and all the other reasons that I just explained. So what am I doing myself? Well, I continue to invest in the stock market, but I am being much more strategic about it, much more cautious about it, only really investing in companies that I really believe in for the long term. Also some dividend stocks, because I do think volatility will continue, and I'll be able to collect those dividends through all of that volatility regardless of what's happening with prices, assuming that they're good dividend paying stocks and companies that will continue to do so. But I do feel a little bit out of my comfort zone because I obviously do most of my buying when stocks are going down. So back in March, I was buying very heavy at that time because I accelerate my buying when stocks are going down. Whereas right now stocks have been going up. So I've been slowing down my buying. More of my monthly or weekly budget has been going to my cash portion, so that if that correction comes that I'm kind of predicting here, I will have those funds to be able to take advantage of that. And especially if there's a crash, I'll have those funds available to take advantage of those more attractive prices. And of course, all of this is under the assumption that I have a steady job and steady income, and that I have savings for emergencies and things like that. Because I always get comments from people, well, what if I don't have a job and everything else? Well, in my opinion, you got to take care of yourself first. Investing comes second. So make sure you've got a steady job, steady income, and emergency savings. And if you don't have those things, might want to reconsider investing in the stock market because you're taking on a lot more risk at that point. So take care of yourself first, investing comes second. That's just my opinion. Not telling you guys what to do, but that's just my opinion. Okay, so having said all of that, when will the stock market really pop, in my opinion? If we're under the assumption that valuations are too high, when is the next kind of big crisis? Because all of this really happened because of a global health issue that nobody expected. So a lot of people were saying, well, we're overdue for a recession, we're overdue for a big economic crisis. But what's going to cause it? Well, I can tell you nobody, at least nobody I've talked to, was expecting a global health issue to kind of cause this. In my opinion, and this is what I've been saying in a lot of my videos, whenever I made any kind of predictions, when I talked about what's going to cause the next fundamental economic crash and pop the so-called stock market bubble, if we're indeed in one, I've always said that it will be debt driven. It'll be caused by debt. And I'm talking government debt, consumer debt, and corporate debt. And we're looking at like consumer and corporate debt, that can result in bankruptcies and lower growth, like a stunt on growth and things like that. When looking at government debt, then you're talking about having to maybe print your way out of that debt, which can lead to hyperinflation. And we all know that hyperinflation can really destroy the economy in a major way. So in my opinion, that's when we're going to have the next real economic kind of crisis. It's going to be debt driven. And this global health issue has only made my argument for that even stronger because we've taken on so much more debt, unbelievable amounts of debt. And I'm not sure how we're going to get out of it. Again, in my opinion, I get the feeling that we're going to have to print our way out of it, and that could lead to high levels of inflation. So we'll see. We'll have to see how that all plays out. Anyway, I think that does it for today's video, and I hope you guys enjoyed it. And let me know if you agree or disagree with anything I said. Let me know your predictions and thoughts down below. I'll try to respond to as many as I can. But thank you so much for watching the video. And I really do honestly hope that you guys are all doing okay and your families too. And I'm talking both health-wise and financially. I wish you all the best, and you're all in my thoughts and prayers. I promise you that. But anyway, thanks again for watching. I kind of make sure I don't get emotional. Thank you for watching. I really appreciate all the support, and I'll catch you guys in the next one. Take care. Bye-bye.